Like the US, the European Central Bank too has held interest rates steady at 2% on Thursday, warning that the US-Israeli war with Iran is clouding the outlook for growth and inflation in the eurozone. Rising energy prices and geopolitical risks are complicating the central bank's policy decisions.
The European Central Bank left interest rates unchanged as expected on Thursday, but its chief, Christine Lagarde, said it was closely watching growth and inflation risks from surging oil prices and was ready to act if necessary.
We are well positioned to demonstrate our capacity to apply our strategy and to be agile, to do what is necessary, because, second point, we are determined to ensure that inflation stabilizes at 2% medium term.
Energy prices have jumped since the US-Israeli war on Iran began on February the 28th. It's driving bets that inflation will be pushed far above the ECB's 2% target within months. That could force the central bank to tighten policy to prevent rapid price growth from becoming entrenched. Markets now expect more than 2 hikes in the ECB's 2% deposit rate this year. Policymakers were accused of acting too late on the 2021-2022 inflation surge after Russia's invasion of Ukraine. And analysts think they will be quicker to pull the trigger this time. Central banks normally look past such energy shocks since expensive fuel saps consumer demand and drags down economic growth. Policy moves will ultimately depend on the duration of the war. And the ECB's own economic projections reflected this uncertainty.
It will have a material impact on near-term inflation through higher energy prices. Its medium-term implications will depend both on the intensity and duration of the conflict and how the energy prices affect consumer prices in the economy.
Financial market pricing now assumes inflation will rise to the vicinity of 3.7% in the year ahead. But these indicators are volatile and are prone to rapid changes.
Europe is scrambling to contain the economic fallout as the Iran war hits global energy supplies. European countries have rushed to cushion the impact of soaring oil and gas prices after strikes on key Gulf energy facilities, including Qatar's Ras Laffan, the world's largest LNG plant. Leaders across the continent are weighing financial measures to protect households and businesses as energy costs spike sharply.
European countries scrambled to cushion the impact of soaring oil prices on Thursday after the most economically significant escalation of the US-Israeli war on Iran. EU leaders gathering in Brussels were set to try to offset the jump in energy costs. It follows a number of strikes on Gulf energy plants, including the world's largest gas plant in Qatar. State oil giant Qatar Energy reported extensive damage after Iranian missiles hit the Ras Laffan industrial city. It processes about a fifth of the world's liquefied natural gas. The strike was in response to Israel's bombing of Iran's major gas field. Saudi Arabia's backup oil port on the Red Sea was also attacked by Iran. The seemingly precise strikes were a dramatic demonstration of Iran's continuing ability to respond to the US-Israeli campaign, and highlights the limits of air defences to protect one of the Gulf region's most valuable and strategic assets. It also suggested a lack of coordination between the US and Israel almost 3 weeks into the war. Trump said the US had no advance knowledge of Israel's attack on Iran's gas field, and that Qatar, a close partner of Washington and host to the Gulf's biggest US airbase, was not involved. As surging energy prices stoked inflation fears, the likelihood of interest rate hikes increased ahead of Thursday's European Central Bank and Bank of England meetings. Brent futures were up about 7% to more than $114 a barrel by mid-morning, while European gas prices have leapt by over 60% since the war began at the end of February. Saudi Arabia intercepted a ballistic missile launched towards Yanbu. The port city serves as the kingdom's only outlet for crude exports since Iran, in effect, closed the Strait of Hormuz.
And Europe's aviation industry is pushing back against what it calls burdensome regulations around sustainable aviation fuel as Iran war-driven fuel costs surge globally. Airlines argue that higher fuel costs linked to the war are already squeezing margins, making it harder to meet green targets.
European airline chiefs were meeting in Brussels on Thursday under the cloud of war in the Middle East and soaring oil prices. They're pushing back against the EU's green agenda and what the industry says are cumbersome rules surrounding sustainable jet fuel. Reuters reported earlier this week that, citing a lack of available supply and high costs, Europe's airlines are expected to call for regulators to roll back mandates for the use of synthetic sustainable jet fuels starting in 2030. Air France, KLM, Ryanair, Lufthansa, EasyJet and British Airways owner IAG have for years lamented the issue. They see the rules as a burden on Europe's airlines, allowing Asian and Middle Eastern carriers a cost advantage. The green jet fuel industry and environmental groups insist the shift is necessary to reduce the sector's reliance on oil. While sustainability is in focus, the Iran war and oil prices above $100 a barrel will likely be front and centre. The Middle East conflict, now well into its third week, has thrown aviation into turmoil. Flights have been cancelled or rerouted thousands of miles, and most airspace over the Gulf is still closed amid fears of missile and drone attacks. Jet fuel prices have spiked, pushing up operating costs. European prices have doubled, and Asian prices are up almost 80% since US and Israeli strikes on Iran began in late February.